this is to end in fire, then we shall all burn together. Watch the flames climb high into the night, calling out, Father, oh, stand by and we will watch the flames burn over and on the mountainside. And if we should die tonight, we should all die together. Raise a glass of wine for the last time, calling out, Father, oh, prepare as we will watch the flames burn over and on the mountainside. Desolation comes upon the sky. Now I see fire inside the mountain. I see fire burning the trees. And I see fire, hollow soul. I see fire burning the breeze. And I hope that you remember me. Surely I'll do the same. Confined in mountain holes, we got too close to the flame. Calling out, Father, oh, hold fast and
Hey everyone, hopefully you can hear and see me, and you're not annoyed at too much Ed Sheeran this early in the morning. Hopefully we've got the team at Exact Accounting there. I can see Phil's just coming in, Suze and Josh.
Good morning,
Jules.
How's your morning going?
Very well, very well. A little bit unseasonably cool in Queensland.
It is.
Yeah,
Well, I'm in Melbourne, so
yeah, but it's not supposed to be cold in Queensland.
No, it's supposed to be nice all the time.
Well, I'm first webinar I've done where I'm actually a bit more wrapped up than I normally am. So yeah. Thanks to everyone for joining. We normally just try and wait a few minutes, just people slowly trickle in from other meetings or things that they're up to if they're getting up on site and want to join in. So I appreciate you all coming along today. So as you've probably seen in the invite and stuff that went out there, this is obviously to try and help people to understand what to do at the end of financial year and around tax. You do not want to hear any advice from me on this at all, because I know absolutely nothing about tax. Despite working for an accounting software company for I think 6 years, the further I stay away from tax advice, the better for everyone involved, I think. Before I bring in Exact Accounting, do an introduction on kind of who they are and what they do. Whilst I was working at MYOB at the time, one of the things that I used to spend a lot of time talking to bookkeepers and accountants, and it was a lot of advisory things that we were talking to them on in terms of, you know, how to better serve their clients, transform their business, all that kind of stuff. One of the big problems that a lot of people in the industry face is they have too many different types of clients they work with, different industries. So you'll see an accountant or a bookkeeper that might work with hospitality, manufacturing, trade, so on and so forth, right? And what happens is that whole jack of all trades, master of none, is that you can be really good at just doing the general things in the business. And I think accounting and bookkeeping, 10, 15 years ago, that was really what it was. A lot of it was about. It was a lot of data entry, especially for bookkeepers, and tax accounts obviously was more around the tax stuff. But nowadays that's really changed, and the amount of advisory services bookkeepers and accountants and can get involved in, and how much they can impact individual businesses, you know, grown massively. And a lot of people weren't taking that up. So what tended to happen was you were getting people that were giving really generic advice, not specific to the industry. And one of the things I was always talking to these bookkeepers and accountants about is you need to focus on a particular area, because you'll become the subject matter expert. You're the people to go to if you need any questions answered in that particular space, rather than trying to learn every single little bit of legislation and changes that come into a particular industry and how that people do business. And that's everything from, you know, apps like Build Exact, or if you're in some of the more trade style work, it might be ServiceMate or Traderfire, something like that. If you're in you know, manufacturing, there's probably a bunch of different apps you can use for those things. So it's really hard to be kind of really broad, which is where some people do fall down on. Obviously at Build Exact, what we try and do is we try and bring in people to give advice in a particular area that's what they do in that particular space, and they're the best people to go to for that particular space. And that's sorry, really long kind of talk on that, but I just wanted to stress why it's so important to have people like Exact Accounting that we work with really closely, because we know that if we want to talk about accounting and tax and all that kind of stuff, it's like these guys know what they're doing. So hopefully I haven't pumped you guys up too much that you're gonna be able to live
You've
up to
taken
it.
away our first like 10 slides, I think.
10 slides ago.
But yeah, I guess first I'll bring in you, Phil. So we've worked obviously quite close together for a while now, but do you want to do a bit of an introduction around
Yeah,
what you do?
I'll just get my screen share happening here. Hopefully that works for everyone. Yeah, so thanks, Jules. We really do enjoy working with Build Exact. Great software, Australian made, lovely bunch of people to work with as well, which I really, you know, we put a lot of importance on that. Yeah, so today it's a triple act. We've got Josh and Suze, who are our accountants. Josh, I'm sorry again, I've left your CA designation off the end of your name.
Been demoted. I've lost my CA status.
Yeah, you are a chartered accountant, and so is Suze. We're all three of us are partners in at Exact Accounting. I'm really just facilitating today. I'm going to kind of guide us through. But the real information, the expertise is coming from Suze and Josh. And as Jules said at the top, these guys have been working in the industry for ages. We really just do building and construction. So that's where a lot of their expertise, deep expertise comes from. Just quickly on our services, we actually, I think we've got a few clients on today as well. So hello to those clients. Thanks for joining us as well. Just looking at the list there. But in our firm, we do 3 separate services. We do bookkeeping, and as Jules was saying, it's almost more about system integration these days in building and construction. You know, you have Xero as your kind of base platform by and large, and then you need to integrate your specialist software over the top of that, and that's what this bookkeeping division of ours is all about, and everything that you'd expect a bookkeeping team to be doing, you know, APAR, payroll, and the like, but really just specialising in building construction. Compliance, which is where Suze and Josh and their teams live. So tax, structuring, all of the sort of QBCC, iCare, you know, all of that sort of compliance around the licensing that has to occur in building and construction. So, you know, we've become real experts in that space. And then our CFO advisory division. And so while Suze and Josh are tax accountants, and that's where their major focus is, we have a whole other division of, I guess, what you would call commercial accountants. So these are people who have worked in businesses as financial controllers, as CFOs themselves. They have a portfolio each around sort of 10 to 15 clients, and they provide that CFO level support to businesses that are growing and struggling with, you know, I guess, how to maximize profit, how to understand the financial metrics and all those sorts of things, but probably can't afford a full-time CFO. But really need a good running mate. And so our clients then, therefore, often they're scaling up. There's a lot of growth going on in the industry still. You know, the numbers will say that it's slowing down, but from what we hear, there's still a lot of work going on. And so our clients are usually growing. They're growing themselves, so they often have a growth mindset and they're wanting to learn more. It's great that that everyone has come on today, because you would be in that category of people. If you're turning up to a webinar on tax for building and construction, it means you're wanting to learn more and grow more. So that's usually the sort of client that we love. They're also starting to think as well that it's time for a specialist. So rather than having a generalist accountant who's doing, you know, cafes, hairdressers, pharmacies, whatever the case may be, they want that's time to move on to someone who has specialist background. And they really need a finance and accounting running mate, because it can get lonely running a business, and there's a certain point where trying to work it out yourself and ask for advice here and there is going to get you. At some point, you really need to have, you know, a really good specialist advisory team, you know, plug in to help you navigate the next stage of growth. So that's our clients. Some housekeeping today. Our agenda. So we're going to, I will quickly take us through a couple of the first principles that underpin the way we approach tax and structuring in this space. And then Suze and Josh are going to take us through what we call the tax journey, which really means that we've broken up the content to hopefully suit people regardless of where they're at in their growth journey. Might be just starting out, or they might be, you know, really have been in business for a long time and they're looking for some more sort of expert level tips. We're going to run some polls along the way. Jules is going to help out with that. This is, we found just an easy way, like we'll refer to various resources and tools and things. And rather than having to pull out your phone and scan QR codes and things like that to get these additional resources, we just thought it was easier if we run a poll and you can opt in or out based on that. And questions, please. I think we actually do have the chat activated, and people can be throwing questions into the chat as we go. We're going to stop at the end of the three main sections and take questions on the section we've just covered. And at the end, we're happy to hang around as well longer if people want to ask questions at the end too. I will say, don't feel silly for asking questions about this stuff. You know, Suze and Josh are real experts. You've got them on the webinar today. So please don't walk away having not asked the question that you really wanted to ask. I will also mention we've got an ebook that's out at the moment as well, so we'll refer to that at the end. If you get our newsletter, you will have seen that mentioned in the newsletter in various places too. It's going to be, I guess, the longer form take-home resource of some of the content that we're going to be talking about today. So you can always refer back to that ebook if you want to sort of check in on some of the content we've covered. So let's get going. So before we begin, this is part one of before we begin. This is a disclaimer to say that we're going to cover some general information today in the tax and structuring world. It's always really important that you take on external professional advice before you make any decisions. And certainly I will say as well for our clients on the call, if we say something that, you know, jogs your interest and it might be slightly different to what we're doing with you, that is because everyone's circumstances are different. And so it really pays to make sure that you get specific advice for your own circumstances. We've also simplified some of the examples we're giving today as well, just to be able to communicate and help teach some of these concepts. So we've simplified them too. When it comes to tax, we always try and take a balanced approach between the tax strategy, so what we're trying to achieve from a taxation perspective and compliance perspective, versus the commercial strategy. And so we wouldn't ever recommend our clients do something just because there's a piece of tax legislation they can exploit if it compromises the commercial running of the business or the commercial health of the business. So, for example, if you aren't in a position from a cash flow perspective to go out and buy a new ute, we wouldn't recommend you go and do that just because it's coming into the end of financial year or because there's, temporary full expensing and those sorts of things on offer. So we really try and balance the tax side of the business and the commercial side of the business. The other thing is we also try and balance what is available to us under tax law and what the opportunities might be from a tax perspective. We like that to try and take our clients really close to the line as much as we can to exploit every opportunity that's available to us. But you need to be in a position where you can sleep well at night and not be concerned that if the ATO in all of their data matching capability picked up that you're doing the wrong thing and came for you, that you wouldn't be in a compromised position. I'm sure there are plenty of accountants out there you can go to who will do things that we wouldn't approve of and be on board with. We're not those accountants. We want our clients to do as well as they can, but also be safe at the end of the day as well. And then the final part is that it's great that you have come along to this. We think that tax is probably less understood. Well, it is. It's less understood by business owners than it should be. There's often a lot of focus on how to make more money, and then not enough focus on how to keep that money, rather than hand it over to the ATO, or more of it than you should. And so it is something that you should be proactive about, and you should be working proactively, particularly at this time of the year, to put in place a really strong tax plan on how you're going to have the best possible outcome for the upcoming year and beyond. But it's up to you and your accountant. So make sure you've got someone that you're working with who is also proactive on their side of the fence too. The tax journey.
Before you get going, Phil, that's
Yeah,
just
mate.
jump in, mate, because
Yep.
hey guys, just a quick heads up. We did this a few weeks ago, and we actually realized maybe like 20 minutes in, the chat wasn't working. So if you guys are listening and you can hear
Yes,
me,
good
okay,
idea.
can you just go and pop in if the chat is actually working for you, first of all, just so we can actually see that you guys can hear us and you can read the chat and you can see the chat. Yeah, brilliant. Kelly's in there. Awesome. So it's definitely working. Can we also just see where are you guys actually dialing in from as well?
Yeah,
So,
that's a good
state
idea.
or the city or
Brizzy, yes, very good.
Ballarat.
All right.
Oh
Toowoomba.
my God, the
Toowoomba,
Margaret
yeah.
River.
I was up in Toowoomba last week, yeah.
Yeah.
For the Master
Sunny
Builders.
Coast, Brizzy,
Hands in there.
Victor Harbour.
Victor
Cool.
Harbour.
Yeah.
Brilliant. And obviously
Newcastle. Say hello to my family in Newcastle there, Melody.
and obviously the team here have things they're going to be talking about, guys. But if you can just pop in some of the things in particular that you might be looking at, or if there's any questions you want to get in now so we can cover them off. And yeah, just what are you looking for out of say? What got you to join? What kind of advice in particular are you looking at? What areas? If you can just pop that in the chat for us as well, that'd be great.
Yeah, this often, helps us kind of zero in on a few things in some more detail. While those questions or suggestions are coming or not, we do. I should have said, when it comes to questions, if it gets really deep technical tax, if it gets into that sort of vein, we are happy to answer any of that stuff, but I don't really want to leave behind the rest of the audience. So if it gets a bit too in the weeds with some of this stuff, or very specific and highly kind of tax law, tax legislation, then I think we'll just more than happy to take that stuff offline with people. All right, so Jules, there's not really much action there.
No one's put anything in, so
yeah.
Maybe it's just a general advice that people came for. But guys, if you have anything in particular, just feel free just to pop it into the chat. Just make sure you tick everyone on. The Q&A section is there, but I'd recommend just using the chat. It's probably just easier for everyone to see and kind of work through. So I think Q&As can only be seen by us on the panel. So
cool.
Tax journey time.
Thanks for that, Jules. I know you were waiting for me to like take a breath there so that you could jump.
Yeah, we were all messaging saying like Phil doesn't breathe. He just talks, and I think he breathes as a word's coming out. He takes a little short mini breaths every time he
It's
says
my didgeridoo skill.
You can just continue going.
So this tax journey, let's go. So as I said, we're going to cover stuff today for hopefully for something for everyone. Whether you're a newbie, we're going to go over a whole bunch of stuff if you're just sort of starting out, or you feel like you still don't have your foundations right from a tax perspective. Getting there, so you've probably been trading for a number of years now, and things are going well, or maybe you're having some challenges, but you've got the legs under you now, and you want to really start to level up from a tax perspective. And then the last section is nailing it. So these are people who hopefully turning over some pretty decent profit and really want to make sure that profit is protected and taking advantage of the best possible tax opportunities on offer. And so, if you take away one thing today, we'll be happy. And that's what we usually say. If you take more, then that's bonus. But hopefully there's something in there for everyone. As well as if you're on fire, there's my little ambulance. We're going to, at the very end, we're going to cover off on some ideas if you are really struggling under debt, and particularly ATO debt. And there's some really solid options in that space now as well. So we'll cover off on that too as a separate piece. Righto, apparently everyone's sick of hearing me rattle on, and we want to get to the meat. So let's go for it. Suze is up first and is going to be talking about structure.
Thanks, Phil. Yeah, so as Phil mentioned, if you're in the newbie space, and as we said, we're going to structure this in that fashion. So we're talking a little bit now toward those that are either just starting out or feel that you're sort of still getting your foundations right. Most times we'll see that you're either trading as a sole trader, so in your own name, and you've just gone and registered your own ABN, or you may have set up a company, possibly even a trust, but we don't see that as commonly in this space. So you're possibly looking at either a sole trader or a company. We do see some people still operating in partnerships at this level. We're not going to really talk about those today. They're not as common anymore, but they are still floating around. So if you are in a partnership structure, just consider that there may be some other options that you need to have a think about when you're looking at tax as well. And we've just outlined here a couple of the pros and cons with either sole trader or company. And the main one for sole trader, of course, is it's simple and it's easy to set up. You register your ABN and away you go. In some cases, you might even open a separate bank account. And if you're talking to your accountant, they will highly recommend that you do have a separate bank account for your business activities as separate to your personal activities as well. The main cons in relation to sole trader is you don't get any asset protection. So everything that you own, business assets, personal assets, they're all lumped together under you. If something happens to the business, all of your personal assets are potentially exposed as well. So that is a really big con in relation to sole trader type activities. And that's when we would consider something like a company to try and separate those out a little bit more. And we've just made that note there that you do get better protection for assets under a company structure than you do with the sole trader. And of course, tax rates are the other one, and that's why we're all here today. A company has a flat tax rate of 25% while you stay as a small business, whereas your sole trader income can be taxed depending on how much you're earning, and we'll talk more about that later, way up to 45 and plus, so 47% roundabout in terms of earnings. So there's a couple of issues to have a think about in terms of how you're structuring and which structure might be the most appropriate for you. Josh is going to chip in now and have a bit of a chat about our tech stack.
Yeah, you might think tax webinar, tech stack. Why are we talking about tech stack on a tax webinar? Well, it's in the same vein as getting your business set up with the right structure and the right reporting from the beginning and not leaving that to the last minute or as an afterthought. So ultimately, when you're running a business, somewhere you'll have to have an accounting platform picking up all the data. Now, there's a bunch of different accounting platforms in the market these days. One that we're particularly aligned with is Xero, mostly because it's one of the cleanest, user-friendly pieces of software available on the market today. So ultimately, you need to have that done from the beginning. And Susan and I see this a lot, where if it happens as an afterthought, it's usually a real mess. So must do this from the beginning. But these days, it's all about our connected ecosystem in terms of software. So what we're looking at now is a tech stack that makes things easier to collect data. So you want to have a few areas, right? So you want quality data as well as being able to collect the data efficiently and actually make business decisions using this data, actually accurate business decisions. So looking at this ecosystem here, so particularly in building construction, I can't stress enough the importance of having an estimating, job management, and job costing platform. One that, as you can see here, Build Exact, that exact piece of software that do that. There are other platforms out there as well, but we particularly like Build Exact. It's Australian-based, it's clean, easy to use, and it is nice and linked with Xero. So in Build Exact, to spend a bit of time on this as well, and Julian can jump in if you want in a second, mate, on things around two-way sync and making sure that ecosystem is connected. And another important point, and I'll get to why it's a tax benefit here in the long run, is receipt capture is just so important. You just don't want shoe boxes or receipts flying around everywhere. It all should just be a tech play these days with no paper flying around. So something like Dext or HubDoc, those sort of platforms, they're really great at basically, it's an app on your phone. Take a photo of the receipt. It'll read the receipt really well. It's very clever technology, and it can code it into Xero platform, and through the two-way sync process, it can push up into Build Exact to make sure that you are job by job costing as well. So it's a very well-connected ecosystem. And fundamentally, what are we aiming at here? We want better reporting at the back of all of this. So better reporting means better tax management with your accountant, because the accountant's got actual useful data to do something with. So that's why the tax stack at this point is really important to consider out of the gates. Now, Jules, you want to add anything on top of that, mate?
Yeah, obviously from a tax point of view, everything Josh is saying there is correct. You want the most accurate reporting you can get in, but from a starting point, if you're not estimating correctly, none of that stuff is really going to matter, because you're going to lose business, you're going to lose money, and I think if you lose money, you're probably not going to be paying much tax to even worry about it. So really, really key principles there is making sure your estimating is done accurately, fast, before you even start, thinking about the job management side and the reporting side of it. So look, at this point, for me, I just want people to use software and use it efficiently, whether it's us or someone else. At this point, we just want to make sure the industry is using software. The amount of people I still speak to that are just using Excel sheets and doing everything manual is insane. Like, if you put anyone that kind of in my position now, is like, there's absolutely no way on earth I would be doing things manual. And I understand everyone's at different sizes and things like that. Use a software that is appropriate for your size of business. If you don't want to end up using something else and maybe we're a bit too big for you, but just please use something. And obviously, Xero is the leader in that as well. Like most builders we speak to are on Xero. There are people that still use MYOB and QuickBooks and stuff, but Xero seems to be the best for most people.
And getting everything connected properly. I think we're seeing quite a lot, digital transformation in the industry, people moving away from paper, moving away from Excel and going onto platforms like Build Exact, and that's great. I think the next mile is a really critical one, where you actually get those platforms talking to each other properly, and you have your bookkeeping function have all the right processes in place so that it's a really reliable and efficient workflow process. And so you avoid errors, you avoid having to double enter data and all that sort of stuff. So
you have that sort of curve where you see people, the first people that adopt it really, really early. And, we've been up and running for, a while now, and then I think we're in that stage now where most people know that they need to use software, whether
Yep.
they want to do it right now or not. Most people know that, I'm going to use it at some point. I was going to get around to it. I think we're in that sort of area right now.
And then it makes a huge difference, from a tax perspective in terms of the efficient access to data and information for both parties, for you as a client, for us as the accountant. If we've got that tech stack, working like a well-oiled machine, we're not burning time on the nitty-gritty of where's the data, is it matching, all that sort of stuff. And we can be talking a lot more about the opportunity side of things. So yeah, big shout out for people. Actually, I think that's our first poll, Jules, which is our next one. Like I said, I think the industry is kind of at the point where we've got these platforms in place, but a lot of people don't have it connected up as well as it could be. So I think this first poll is if you are interested in getting some help from either us or Build Exact on how to connect up your tech stack in a better way, then we're more than happy to do a free consult and give you some advice on that, because we're not going to go obviously instructional on that today. But if you did want a hand with that, then this is your opportunity to put that hand up.
Yeah, and guys, if you are using Build Exact or you're thinking about using us, we do have partners that actually can help with things like getting your templates and your recipes created. So if you're maybe holding off on using a software because you think, I've got to go and enter all this information and do all that kind of stuff, we do have partners that can go in and help you with this stuff. So you might have already answered the question and maybe you can't go back in and edit it. I'm not sure if you can or not, but if you are one of those people, you want someone to help with that side of it, definitely just reach out in the chat and I can pass my details and whatnot. I don't know how keen Phil would be to be creating recipes for framing, but you can try.
Not. I mean, we try and stick our lane, and our lane is very much, job costing, your cost tracking, making sure that you've got, you're allocating labor to the right job, and managing like overhead labor versus COGS, all of that sort of stuff, so that at the end of it, you've got awesome visibility over your margins per job. That's our language. You can have your recipes, mate.
Okay.
Yeah. Righto, let's move on. Suze is going to talk about something that almost every builder and tradie is going to have at some point, or lots of them, cars.
Yes, absolutely. So in the newbie space, you've got your structure set up, you've got your tech stack working. Often what happens next is you're looking at, how do I get out to my jobs? What am I going to do in this space? So we see lots of people start looking at the option of buying a vehicle, whether it's a car, whether it's a ute, whether it's something more commercial like a fitted out van, or a specially crafted, for want of a better word, ute. So a couple of things just to keep in mind when you're looking at vehicles. For tax purposes anyway, anything that's over, I think it's about 79,500, will incur what's called luxury car tax. There are a couple of exemptions where it is a commercial vehicle and things like that. That's a dealer imposed tax. So as in, it's imposed at dealer level. It's not dealt with in your tax return or your activity statements or anything like that. It's purely just imposed at the dealer. So when you are buying a vehicle, just keep that in mind, that you could potentially be looking at an additional tax imposed at purchase if it's over about that 79,000 mark. The other one to keep in mind that is one that a lot of people forget about is there's actually a limit on how much depreciation you can claim on your vehicle. And we've got an example coming up that sort of goes into that in a little bit. But basically, if your vehicle costs more than 68,000 and something, it changes every year with inflation, and it's always an odd number. It's something like 68,281 or some odd number like that. If it's more than that, you're capped for depreciation to that limit. So if you buy a vehicle that's worth 150,000, you potentially don't have the ability to claim that extra 90-odd thousand that you've paid for that vehicle. Again, there are some exemptions. So if it is a commercial vehicle or it falls into that space, you may have the ability to claim up to that full amount that you've paid. A really good example of that is diggers or big machinery like that, trucks and different things like that in that space are very, very clear that they fall outside of this. So just be careful that there is that. GST credits as well is also an issue in that if you're capped for depreciation, you're also capped for GST. So if you've paid 150,000 for your vehicle and you've got roughly 12 or 13,000 of GST potentially sitting there, you actually can only claim up to the 68,000 or around about 6,800 in GST. So be aware of that you might actually lose a little bit of what you think you could otherwise claim in terms of tax. So an example that we've got here, say you have purchased a Hilux, it's cost you just under 51,000. Because it's under our depreciation limit of 68 and it is a commercial vehicle as well, we can claim the full amount of that. Now, bear in mind, last year, if we'd done this before 30 June 23, we could have claimed the full cost of this in our tax this year, in that year. That's now been reduced. So our depreciation limit right now is only $20,000. So your car must cost less than $20,000 to claim it in full. If it costs more than $20,000, you have to depreciate it over the lifetime of that vehicle, which is roughly, in most cases, about 4 years. So that means that instead of getting the full amount we can claim, we can only claim a deduction of $11,600 per year, thereabouts. And we're entitled then to a GST credit on that vehicle as well of 4.6, which is based on our purchase price of that 50-odd thousand. There's a couple of queries starting to pop through in relation to electric vehicles. If anyone's looking at electric vehicles, there are some other special rules that might fall in relation to those, but largely they follow the same rules. We don't have a lot of exemptions in that space. There is an exemption in the FBT sphere, which we're not really going to cover today. So in terms of newbies, that's really not an issue at this point in time. So moving along, where you are in a sole trader situation, you do have two options in relation to claiming vehicle costs. We do have cents per kilometre. Now, this is a good one to know in that it's capped at 5,000 kilometres per year. Most of you guys out on the road attending jobs and so forth are going to clock up way more than 5,000 kilometres a year. Often we see people looking at 15, 20, 25,000 of work-related kilometres. You'd almost be a fool to cap yourself at 5,000. And we've got an example in a minute about what that looks like from a tax perspective. Your much better option is probably your logbook method. And I know it's always feels like a drag. You've got to keep a logbook. You have to keep it for 12 weeks. It has to document what the trip was for, how far you went, opening and closing odometer readings, etc. But it actually can generate you a much greater claim. So your 5,000 kilometers per year maximizes your potential claim to $4,250. If instead we had the logbook method, and we're assuming here we've generated an 85% logbook, work-related logbook amount, we've outlined some of the expenses there, and we've said total expenses for the vehicle could come in around $23,500 for the year. At 85% of that deductible, including your depreciation, you actually could have a claim of $20,000, which is a saving of just under $10,000 in tax. So just keep in mind that your logbook could be running you a much better option than your cents per kilometre. For those of you trading in companies, there are some other things to consider, but largely you'd be looking at logbook method, looking at whether the vehicle's owned by the company and how you account for it that way. That's a conversation, obviously, for your accountant, but just bear in mind there are those two options, but the logbook generally tends to give you a much better outcome in terms of your tax. And Joshy is going to have a look at our home office.
Home office. So we're going to jump out of Suze's Hilux. At the end of the day, we're going to go back to the home office. We're going to punch out quotes. We're going to do some of our book work. And there might be then the question of, well, can I claim the actual home office time that I'm spending? So short answer is yes. And it's actually surprisingly very similar to the concept of cars, where there's one method where it's a sort of a cheat method of here's an amount per hour. And then there's another method, actual cost, which is essentially a logbook method. Again, the only real change or difference with home office, there's a slightly additional overlay of where you literally have no other place to work and your place of business is actually your home or home office. Then there are some additional costs that you can claim, but we have to be aware of them. So I'll just go into the detail high level here. So fixed rate, the simplest form is basically how many hours are you working in your home office at a set rate. And the core thing around that is that it is incorporating things like internet, phone, energy, printing. So it's an all-encompassing rate, very similar to the car cent per kilometre concept. If you have any other assets, though, if you're buying chairs, desks, computers, etc., you can claim them as an additional depreciation. So anything under 300, you can claim that as an immediate claim, and anything over that would fall into ordinary depreciation, which basically means you get to claim it over its effective life over a number of years. Usually technology claims over only a couple of years, because usually technology isn't deemed to really last for 10 years. So the key thing that you need to do there is keep records of actual hours. So they're not asking for a hardcore logbook on that, but you do need to demonstrate how many hours you were in the home office for work purposes. So diary records, those sort of things would meet satisfy the requirement there around the fixed rate. Now, actual cost, this one, in nearly every case, if you do follow the actual cost, you're likely to get a better outcome than fixed rate. It all just depends on how much more effort you want to put into on collecting the right data. So the actual cost method, as it suggests, you grab the actual costs of internet, phone, energy, printing, and you actually look at how many, and nearly all of those services, internet, phone, energy, have unitized based billing. And so basically what the requirement is there is determine at a unit level how many work hours of those units that you've consumed actually are business related and what's sort of private. And so we're looking at that work hours from that sort of side. Cleaning, interestingly, strangely enough, cleaning seems to have its own little category to deal with how you calculate it. So if you have cleaning for the house and it covers all areas of the home, then it's based on a square meter rate. So the home office as a proportion of the total home, that's how you're pushing the cleaning costs. And very similar again with assets depreciation, same concept applies. You can depreciate it if it's over 300, under 300, you get to claim it. Now, this is where the logbook comes in. Luckily, it's not a 12-week period like vehicles. It is only a 4-week period, so it's a bit lighter on the logbook method. It does seem strange to do a logbook for home office hours, but the ATO really do need you to be demonstrating that you are genuinely in the home office and incurring those costs for business purposes. So it's either a 4-week period or you keep actual hours across the entire year to justify the claim. So you'll need to be keeping obviously records of the internet bills, phone bills, that sort of stuff. And it's the 4-week representative period, right? So it's not asking you to work out a perfect average across all 12 months. This is a representative period. So they're the two core methods. Now, the overlay to these two core methods, which is fixed rate or actual cost, is an additional element called occupancy costs. Now, this one's a bit more strictly, the eligibility is much more strict in terms of can you actually claim these costs? And it's really only a scenario where there are no other places of work. So you don't have an office to go to. There is actually no other place to go to other than your home. Now, in this case, like fixed rate, you don't necessarily have to work from a specific place in the home. You could work from your couch and claim the fixed rate. Actual cost is lending itself towards more of an actual space, a dedicated space for it, but you might still have some home use of that space as well that's not business related. To be able to claim occupancy, you really need to have a dedicated space in your home that is used just for business. So it's basically you've got an office at the front of the home, and at the end of each day, you close the door and you don't go back into it until you're doing business again the next day. Now, if you're in that scenario, which is going to be common for this industry because you don't necessarily need office space and paying for commercial rent. A lot of building construction will be operating from home in dedicated home offices. And so this is important. So you can do this with fixed rate or actual costs, but basically you look at things like your mortgage interest, if you're renting, rent, rates, land taxes, insurance, all those sort of things now start to play into the claim. And this one's similar to the cleaning, that you look at a square meter rate because you need to have a designated area to claim occupancy. So it's basically what's that designated area as a proportion of the entire home, and then you can claim those additional costs. if you don't meet those strict eligibility, then fixed rate and actual costs are still eligible. This is more an extension of both of those methods. The key thing to be aware of with occupancy. So the first two don't impact your home main residence, because the main residence exemption for capital gains tax is a really important thing to make sure you're aware of it. So fixed rate and actual cost by themselves don't impact that. But when you start claiming things for mortgage, interest, rent, and that sort of stuff, it can have an implication on your exemption for main residence. Basically, it means that your home, if you sell it and you've claimed those costs, isn't 100% exempt from capital gains tax, and you need to be very aware of it. So the key thing, before you go and start claiming those things, you just need to seek advice from a tax advisor that knows what they're doing around that and knows the implications. And you might still form the view that, look, that it is what it is. That's just how it has to operate. As long as you're aware before you dive into it. That's the core thing around the Home Office. I might just, Maurice, you've just got a quick question. It might just be worth answering as we go. If you're fitting out a larger area of the home for a dedicator, can you claim all building costs? Oh, that's an interesting one. It's going to be in the same vein of if you're going to go and start claiming it, your home's going to become less and less main residence. That one's an interesting one where largely I don't think you'd be wanting to anyway, because you will very heavily impact it. And the Home Office in that regard is starting to be difficult to say that it's directly, the building costs are directly linked to the actual income of the business at that point. So that's an interesting question, but it will impact your main residence. So
maybe, Josh, just really quickly, capital gains tax. Maybe if we just explain how that works from a main residence perspective.
Yeah, we were talking about that before the webinar, weren't we?
Yeah.
So the and we had a chat before the webinar started around this exact point on the main residence is not actually, you have to flip around capital gains tax. So everything generally when it comes to property is within the capital gains tax net. The only reason why your home is usually doesn't have tax on it is because there's an actual exemption that applies to it. So it's not that homes are just automatically exempt. It's just that there's this exemption. So everything, well, your home is actually technically subject to capital gains tax. It is just eligible for an exemption. So what we're trying to get at here is, because it's automatically subject to capital gains tax, you have to be careful of then only being able to apply a partial exemption. If
I was saying, I'm going to claim improvements, I'm going to then say that 10% of my home is my business. If we just sort of go with numbers like that, then that percentage would not be exempt from CGT. And so therefore, CGT, capital gains tax, would apply to that percentage of the home. So just as an example.
Yeah, and the main residence exemption is actually a fairly complicated. It's not just simply that. There's actually a lot of elements and arms to that exemption for main residence that you have to be very careful of. And it depends on whether you're in it or outside the property as well. It's very confusing.
There's lots of complicated factors that can come into play. How long you own the property, how long it was used for business as opposed to how long it was used privately. So there's so many different factors that can come into play with those sorts of things that it really does require you to sit down and map a whole timeline of what's happened with the property, when things happened, when you moved in for business, etc., etc. So it can be quite complicated at the end of the day when you're trying to work out, is there a capital gains issue and how much it actually ends up being. Because you could find that if you do some rough calcs, that the actual claim you're making as you go while you're using it for business outweighs the actual eventual capital gain you end up with at the end of the day. And it can still be a very beneficial thing to make the claim, knowing that you've still got capital gains at the end. So don't let capital gains put you in such a fearful state that you say, oh, I'm not even going to bother thinking about claiming it, because you might actually find it's a more beneficial option for you to do your claim and still incur the capital gains later on.
Yeah, I think it's one of those ones where you've got to get into the detail with your accountant and hold the accountant to account. I mean, we were talking to someone the other day at another event, and we started unpacking where they were at. And actually, it on face value seemed like it made a lot of sense actually to make those claims based on the amount of money that was being spent versus the capital gains implications. So I think sometimes, there'll be almost default position in this space with CGT from the accounting world, where they just go, "Oh no, don't do that because it's going to affect CGT." But yes, it will. But what's the best situation here? Like, what's the best possible outcome? So
Yeah. And just to round that last thing out with Maurice, even if you were able to claim it, you wouldn't claim them all up front anyway. There's a provision that exists called Capital Works. You'd only be able to claim 2.5% of the costs over 40 years. So, but it's still, as Phil is completely right, that it still may be worth it.
Yeah.
Yeah.
100%. Yeah. All right.
Okay.
Well, we're going to have a quick look at bad debts. This time of year is a great time of year to review how you're tracking in terms of customer collection. If you've invoiced your customers and you're having trouble getting some of them to pay, what options have you got? And this is one area that we recommend absolutely looking at every 12 months. A bad debt can be written off if it is older than 12 months, if you've made a reasonable attempt to recover the debt as well. And then depending on your circumstances, this actually could be quite significant. If you're looking at building contracts where you may have invoiced $20,000, $30,000, $40,000 and you're not sure that you're ever going to be able to recover it, that's a deduction that effectively can come in and offset the income that you've previously invoiced. So really go through and have a look at your debtors ledger and review for those type of transactions. If eventually, and this is a question we often get asked, if I write it off now, but I do eventually get them to pay, what happens then? Bottom line is, when it does come back into your account and you do receive the money, we would have to bring it back in as income at that point in time. But obviously, you're better off just taking account of that now, getting that deduction now, and we'll just deal with the tax implications if there is income coming back through at a later date.
Okay. This one is a little bit of a sidestep. There's often a lot of, because WIP is a work in progress for anyone who is in a sort of often like a project related space, like, builders who've got project stages. You might be halfway through a project, etc. WIP is often an ongoing accounting issue. We do a lot of work in this space to help our clients understand what their actual WIP figure is, because without understanding it, it's very hard to actually see what your profit is. When you've got cash coming and going in and out, if you don't have a solid WIP figure normalizing your profit, then it is very hard month to month to see how you're going from a profit perspective. So we do find, though, as well with WIP, there's some confusion about whether it's going to affect my tax position. And it's like WIP as an item isn't taxable. And so we want to make sure that people are not confused in that space. But we every time we do webinars like this, we often get questions on WIP because it is a confusing space, and it shouldn't be as confusing as it is. So I just thought I'd throw this in there, that if people wanted to, Jules, can you just throw up the poll for WIP? Because we've got quite a good, it's a separate video that we did on a webinar, and there's a calculator that goes along with it as well. So if you are someone who is scratching their head a little bit about how to do WIP and need a hand, we've got a whole separate sort of webinar on that. And people find that really useful. We had great feedback on it. So if you want that, click the button now and we'll send it out to you. Okay. I think that's enough on that. So we'll move along to the next one, which is Josh, provisioning for tax.
For tax, that's right. So we've got a couple of hygiene things just to round out this section of the presentation. So provisioning for tax, it might seem obvious, but to be honest, we see very little people do it with any sort of real calculation or thought to it. So what we're getting at here is actually look at doing financial reviews on your business, and more proactively across the year, setting aside money for tax. So that's can be GST, income tax, etc. So it's looking at financials. So that comes back to the discussion we had earlier around having Financial Stack have better reporting, which means that you can make better decisions. And a simple, really, really basic way of provisioning for tax is actually set up a tax savings account under the business name. and park the money in a separate account from your ordinary trading account, because then it's a bit more obvious, tangibly, you've moved the money as well. So yeah, it can be a bit more sort of visually clearer for you to have tax set aside. The best thing to do is be working with a tax accountant to do that. This is the core part of the year to be doing tax planning with accountants. We proactively reach out every year to our clients to be making sure that end of year is optimized, as well as looking to the next year. So we're not just talking about tax planning for the 24 year as an example. It's also having a bit of a forward look into what should we be setting aside from 1 July this year, so that 25 financial year is also pretty well sorted. And the other part is the best way to do this is use accounting software and have the reporting, have the connected ecosystem so that your data is up to date, and keeping the data up to date is really important as well. So there is a bit of a rule of thumb that we can use here, because you might be thinking, well, how do we do this? A quick guide for this, and this is in the ebook as well, is if you look at 3% of your gross revenue each month and set that aside, that'll get you a long way down the track to setting aside at least enough money to get you most of the way through provisioning for your GST, your BAS, and income tax. It's a bit of a quick guide, but it's better than nothing.
Yeah, we thought, look, it's good, especially if you're starting out and you don't have, a good kind of historical record, or you don't necessarily have the sophistication set up yet to be able to reliably predict how much tax is going to come into play. Then at least putting aside that, which we've based on, what standard margins are in the industry for residential home builders. That was sort of like the ballpark that we were sort of looking at. But yeah, I mean, really, if you've been going for a while, then really you should not be scratching your head about what your tax position is going to be. There are certainly going to be things that will affect it, but if you're having a decent conversation with your accountant, it shouldn't be a mystery to you, and you shouldn't be caught off unawares by how much tax you're going to end up paying.
That's right.
Right. Little reminder here, Josh, as well.
Little reminder, yeah, and this one's a often overlooked one or misunderstood one. Make sure you're paying your staff super on time. It is only tax deductible if you've paid it on time, and it is only deductible when you actually pay it. So as an example, for the end of this year, this quarter particularly, you might be thinking, oh, well, we could pay our super, you want to pay it before 30 June, so you can get the deduction this year, because when you actually pay it is when it's deductible. The key thing I will mention, though, don't wait till the last minute to pay your super. If you try to push your super, if you're using Xero as an example and using their auto super, don't push it on the 28th of June, because I guarantee you it's not getting it to the super funds in time. You need to be doing that at least a good 10 days plus before, and Xero specify that they want it done by the 18th anyway, just to make sure that it gets to employee super funds on time. But that's the key thing. Don't forget to pay it on time.
Yeah. I was talking to Troy from BusQ yesterday, and he was talking about how back in the day when he was working at the branch, people used to turn up with pockets of cash to try and get it in the account like at the last minute. Don't be that person. Make sure this is done early. Otherwise, it's not deductible. Gareth just making a statement there about 6.25% that he's putting away. I hope that's enough. We're saying 3% based on, some what we would see as, cash flowing through a business, and like a residential builder where you're operating a margin of like, GP of 20, something like that, and then 10% net profit before tax. That were the sort of the rough calcs that we were using. But certainly, Gareth, make sure that you're getting some good advice on whether that's the right amount or not for you. Righto, that is our first round. We're about to go into the next round, which is getting there. So that's all of the newbie stuff on cars, home office, just low-hanging fruit like bad debts. If you've been caught with a debt that is not going to get paid, please make sure you at least get to claim it on your tax. Any questions outside of the ones that we've already had on any of that stuff that we've covered already this morning? I don't know if we're going to get any more because I think we've had some along the way. So we might keep moving. Okay, we're going to our next stage, which, for want of a better term, we've called getting there. We're not there yet, but we're getting there.
We're close.
Okay. And our first slide is for you, Suze.
So typically, as Phil said, we've kind of come through that newbie stage. We might feel like our foundations are right, our software's in place, we're doing a few of these things, we've got everything we need. This is typically where people start to see things get a little bit more complicated. So this is why it's important to get those foundational things right back in the beginning, because when you get to this stage, things can start to blow out a bit. So here's where we see people start to incorporate other things in their structures like trusts. Or if they're operating in a trust, they might incorporate some other companies and start doing some profit sharing and things like that. So we're running a very, very simple example here just to give you an idea of how a trust can benefit you in terms of your tax side of things. So we're just saying here, we've got a simple example of a company generating 600,000 in revenue. We're keeping it, as I said, very simple, direct costs of 300,000, and that includes 100,000 paid to you as the owner. And we're saying 200,000 in operating expenses, which is leaving us with 100,000 in profit. So at the end of the day, what do we do with that? If you're in a company structure, that 100,000 is going to be taxed at 25%. So you've already got a $25,000 tax bill right there. If we push that, we call it at that point a dividend. So we want to pay it out of the company. If we've got a trust in place, we can push it through into the trust, and then we can potentially share that with a partner. So remember, we've just paid you 100,000 as the owner. We've got 100,000 we're pushing through now as profit. We could potentially give that to a partner. And in doing that, that can actually give us some tremendous tax savings. Now, rolling back to when you were a newbie and we were a sole trader, if that 200,000 had come directly to you as a sole trader, you would pay nearly $65,000 of tax on that money. Where we can utilize a trust and share that with your partner, we can then say your tax on the 100,000 that we've paid you as wages is just under 25,000. The company's paid tax at 25,000 as well. That's actually going to mean that that tax benefit carries with the trust distribution, and it means that you could potentially be saving between sole trader and tax nearly $15,000 of tax. So this is where trust can be quite beneficial and can actually give us a bit of a leg up in terms of not, for want of a better word, cheating the tax system. It's not. It's a very legitimate way of actually sharing the burden of the tax. And this is one of the things that their tax system is designed to do. However, there are still a couple of things where the trusts are still being attacked a little bit. There has been an ATO ruling come out over the last, I think it's about 12 or 18 months ago now, where they're looking at these type of trust arrangements where we are sharing income between family members. They've said very clearly that where it is with a partner, we don't generally have any issues with that happening. So what we've just talked about before in terms of saving you 15,000 is quite okay. Where they are starting to get a little bit sticky is where you might have an adult child, an 18, 19-year-old that's off at uni, not earning any money, but holy dooly, do you support them? And I know I've got one of these. They're expensive to put them through uni, help pay their bills. They've usually got a car by this point. All those sorts of things are happening. So we just have to be careful with how we're looking at these distributions where we're involving adult children. What the ATO is saying now is that there has to be a tangible benefit that matches the distribution that we're giving to that child. So that means really, if there's no cash flowing, we have to show that they've actually still derived that benefit. And a very simple example might be we've bought them a car. They need to get to and from uni. They've got a couple of things like that happening. We may have actually given them the money to go and buy a car. That's a legitimate reason then to do a distribution from your trust to that adult child so they can go and purchase that vehicle. So there are still ways of getting money to adult children tax effectively. We've just got to really manage it well and make sure that we're doing this in accordance with what the ATO is now saying is a much more reasonable approach for these sorts of arrangements.
Yeah, and it also applies to even mums and dads as well. So if you're if you've got parents who, and be careful if you're distributing to parents, if they are about to be or are actually on the pension,
Pensions, yep.
be very careful not to just make a blind distribution, think you're getting a tax benefit, because you might knock them out of Centrelink all
Yep.
at the same time.
Yep.
It's the
I
same
had
thing.
another, sorry, Josh, I had another very
Yeah.
similar one the other day with actually a adult child that is on a pension because of disability. And
Yes.
that's another one that we have to be very careful, because any of those sort of Centrelink payments where we start pushing income across can really be impacted by additional income coming through. So we've got to be very careful of those sorts of things.
Yeah, absolutely. Keep your eyes
Yeah.
on it. Now,
Josh.
this one's a bit of a cautionary as well as opportunity section, the Division 7A or the director loan. So this is on the assumption you are operating in a company, right? So the first cautionary thing I want to just highlight is if you're operating in a company and the company's making profits, in the first instance, it's not your money yet. It's actually the company's money, right? So the company makes profit, pays tax at 25% in the first instance, right? So there are scenarios where if you then pull money out of the company, it's what then we call a director loan from the company. So you haven't taken it as a wage or actually officially declared dividends from your company. You've just taken the money out and then having to deal with it later. So the cautionary thing is you can't just take money out of the company and not expect that there's some additional tax implication to actually deal with. So if we start off with just highlighting that, don't just pull it out without any planning behind the company and the director loans, etc. So with Suze's structure before, with the trust in place, you can do this quite strategically with dividends, but there's a few different ways to cut this on how you access company money. So we'll just have a look at what are the actual rules around director loans and Division 7A. So pulling of the money out of the company in the first instance doesn't necessarily attract an immediate tax outcome, right? So the money leaves the bank account. It now looks like you owe the money to the company. Now, if we do nothing with it, there is the provision under there is Division 7A. They'll just basically deem the entire loan as a taxable event to the person who took it out, which we don't want to be doing, because that can be an awful outcome, and it's actually worse tax outcome because you don't get the benefit of the tax the company has actually paid on that profit in the first place. So you can actually use this to your advantage though. So you can take the loan out, but you've got to put it on some complying loan terms. So basically they actually require you to put a loan agreement in place, which is an unsecured loan over 7 years. And so they want you to pay it back with interest. Now, the interest rate these days is about 8.27%. So it's not the cheapest interest rate, but it's not also the worst interest rate in the world either. So it's something to be aware of. Now, in terms of how do we repay this loan? Now, there's three sort of core ways you do it. One way is you put the money back in the company. Practically, though, if you've taken the money from the company, you've probably spent it and you're probably not putting it back. So how do we then deal with the actual loan? So there's two other ways. One way is, well, let's just declare the actual wage that you should have taken in the first place from the company representing the money. So you declare a wage through payroll. You've got to pay the super on it, so be careful of that. You can't ignore your super obligations. And then rather than taking the money out, the wage that you declare through there essentially sets off against the loan. That's one way of repaying it. And again, you've got 7 years to do this, but be mindful there is an interest rate that applies, and the interest rate is actually income to your company as well. So just be mindful of that. The other way to repay the loan is to actually declare dividends from the company. So all we're really doing with Division 7A in this sort of context is, rather than taking the money out in year one and paying all the tax in year one, we're sort of spreading it out across a number of years. And we've actually got the next page is an example of, well, what is there a useful way of doing this without causing a problem? Because I don't want to make it seem like, oh, look, it's just too complicated, don't take money out of the company. No, you can do this legitimately. So say your company's had a great year, good profitability, cash flow is good, and obviously make sure that the company is healthy in the first instance, and it's got proper working capital provisioned. But say the family car's packed it in and we want to buy a new one. So then you're thinking, okay, we're going to buy a new car. There's personal loan rates. Some of those rates can be upwards of sort of 11, 12%, depending on how your credit's looking. And so you go, well, the company's got excess money in it that's not doing anything more than sitting in a bank account. we're going to strategically, with real, purpose, take a loan from the company. We're going to put it on complying loan terms. We're going to pay the loan back by probably declaring dividends, is probably the cleanest way of doing it over the next 7 years. And that is then a very useful way of using Division 7A to your advantage. So it's not to be completely scary and don't do it. You can use it strategically. One overlay on this as well, there's an extra little benefit as well with some of this, is if your company has a substantial amount of excess funds in it because you've had a number of good years, and you're now thinking, well, maybe it's time to invest some money as well. Another strategic way, which I won't dive into now, but I'll plant a little seed in your mind that taking a loan from the company under those terms again, potentially you'll be in a scenario where the interest that you've got to pay on the loan may actually be tax deductible to you as well if you've used the money for an investment purpose. So whilst it's taxable at the company level, you may also get a tax benefit at your individual level. So that's a little bit of a little nugget to leave you with.
I love it when Josh, starts to get excited about those kind of
tax provision. Oh, good.
options. There's some very clever things you can do. But yeah, the principle here is if you're going to get money out of the business, you do need to think about what options are available to you from a tax perspective. We're up against question time again here. We haven't had any really along the way there. I'm interested.
just going to chime in and just add something to what Josh was saying before. And this is on the Div 7A loans and taking money out of the company. I was actually talking to a client just yesterday about this, and they have a very similar example to the one Josh was just presenting. Different purpose for the funds, but very similar. They wanted to take either money out of the company or they're looking at a personal loan. And the lowest personal loan rate their bank could quote them was 15.49%. So if you're looking at a personal loan at 15.49, but your company's sitting there with cash and the Div 7A interest rate's only 8.27, I don't know about you, but I'm pretty sure I know which way I'd be going. So there definitely are advantages if you've got the cash sitting there to looking at these sort of options. They're not always a taboo type of situation.
Yeah. And like the home office thing, like any of these, it just pays to understand what the levers are, have a really decent conversation with your accountant, and then go for it if it makes sense.
Yeah.
One that's come in sort of PM, I am operating in Queensland. I've heard that that QBCC doesn't like trusts. Do you want to? We were talking about trusts before, Suze. As a way of distributing income, via dividend to the trust and then out to the individuals. What are the settings around that for QBCC and operating in Queensland?
Yeah, so QBCC, for those that do operate in Queensland and for those that don't, it's Queensland Building and Construction Commission. Queensland is heavily regulated in that space financially. And as Phil said rightly, QBCC don't recognise trusts as an ability to hold assets or have that net tangible asset position that a company would ordinarily have. And so we in Queensland, when we're working with Queensland builders, we tend to look at companies as a trading structure so that they've got those assets sitting there and can support their license that way. And the example that I gave before is very, very similar to what we do in a Queensland scenario where we would have a trust then as a shareholder. That doesn't impact the QBCC licensing at all, but it does give you the ability to be a little bit more flexible with how you're managing tax outcomes and in that space. So there are plenty of other builders that we deal with in New South Wales, Victoria, other states that aren't quite as heavily regulated that may still be operating and trading in trusts, and they don't run into those sorts of issues. But yeah, largely speaking, we just have to look at structuring and making sure we get that right for QBCC to make sure that those things aren't going to impact a builder and their licensing as they grow and as they start to become, in that space of where we're talking about with getting there and even nailing it.
Yeah, because the core thing around it is trusts come in very heavily as an asset protection mechanism, is why you're using it. But if you're operating in Queensland, because they don't recognise the trust assets, what it ends up doing is you unwind your asset protection, because in the end you've personally got to stitch your own assets to make your license work. So you end up losing the whole benefit of a trading trust in the first place. So we still think trusts are fantastic, We just use them in a slightly different way to get the same tax outcome. You just need to have some nous around how to plan through it.
Yeah, yeah. Okay, there are no other questions, and we've got this last stage to get through, so we might push on. So now
Yep.
we're nailing it. So there's excess. Well, I'd love to think excess profits
Excess,
around,
yes.
and we don't want to have to pay more tax than we'd like on them. So what are our options? Josh is going to take it away with super.
Here we go. We're in that wealth creation phase now, where you've got some money and you're now working out, what do I do with it? Are there some tax advantages to this as well? So super, I'm just going to touch on this high level because anything to do with super, that is squarely in the realm of financial advice. So you must make sure that you are considering that as an overall financial advice. And I would talk to a financial advisor before going and diving into doing a whole bunch of super contributions, etc. But let's just talk about the two main streams of super. So we've got these two buckets. One is before tax or tax deductible super, and there's another bucket of that which we'll come to in a sec. They use the phrase concessional contributions. So concessional contributions, what does that include? That includes the super on your wages, so the super guarantee, so the 11.5% soon, 11%. It includes any other personal contributions that you make and you're claiming a tax deduction for. Now, the key thing around super contributions is be very and acutely aware of your caps, your superannuation caps. So this financial year, your deductible super cap is 27,500. So that's either your employer super contributions or personal contributions, 27.5. From 1 July 24, that's actually going to 30,000 for next year. There was also something that came in a few years ago around carry forward concessional contributions. And what this was doing is it was promoting those who may have not made contributions in prior years. They may not have been making the money or may have been out of the workforce. And it's sort of going, well, you missed the opportunity in those prior years to make contributions. So what you didn't use in those years, we're going to allow you to carry forward. So it is specified for a 5-year period. So you can only carry forward 5 years worth. So if you're at this point now and you hadn't used one, back in 2019, you're probably going to end up in a position where you're locking yourself out from those ones that you didn't use. But basically, the caps in those last few years have been 25, 25, 27.5, 27.5. So if you maybe you're using 10K only of those contribution caps in those prior years, then potentially you've got this carry forward contribution of 15, 30, 45, up to 60,000 from prior years. And if you've had a particularly big bumpy year this year, you might make the decision to utilize those carry forward contribution caps before they expire. And you might go, well, I've got a lot of cash. I want to pump up my super because I haven't been focusing on it. And potentially you have the ability to put in, in that example, a 60K contribution and claim a tax deduction for it. So it's a really positive thing to carry forward concessional contributions. Now, the non-concessional, this is the after tax. So if you're already maxing out those contribution caps at a deductible level, you might still be thinking, well, I still need to maximize my super. Again, talk to your financial advisor about this before you go dumping a bunch of money in, because once the money's in super, right, you're not getting it out for a very long time. So retirement age is you're going to be well into your 60s at that point before you're getting the money out, or 60 at a minimum with some conditions. So non-concessional is you paid the tax on the money, but you still want to put it into super. So the non-concessional cap is you've got $110,000 cap that you can put in. So this is, you want to top it up a bit more. You've got some money sitting outside and you want to put it in. So that cap, you can get some more after-tax money in, so no more tax deduction for it. There is also a non-concessional bring forward. So it's actually in the reverse of the carry forward. So non-concessional bring forward is if you want to put a substantial amount of money into, maybe you've received an inheritance as an example, and you've come up with your financial advisor of a strategy to get it into super, then potentially you can bring forward the next 2 years worth of non-concessional cap and use it this year. So rather than just having 110,000 cap, you can bring forward the next 2 years to now and put in 330, but it does lock you out of the non-concessional cap for the next 2 years, right? So it takes some serious planning around super. Be very careful on it, but there's still a lot of good opportunity in the super space around those contribution caps. Now, complex structuring. This is the stuff that gets Susan and I really excited. It can get complicated as well, but basically, if you're really nailing it and you're generating good, healthy profits, and now you're starting to think of things like, well, am I going to do property development? Am I going to do some investments? And you'll be starting to think about then retirement and some succession planning as well. Now, why do we dive into using a whole bunch of complex structuring? At the core, we're actually trying to minimize risk. So, particularly with property development and building construction, you don't want to blend too many risk things together. Right? Building construction businesses generally are fairly risky just because of the nature of the industry. You don't want to be blending property development investment activities in the same entity. So we use separate entities, we call them entities or structures, to basically put things into little buckets. And largely it's to have risk mitigated. So you're not, something happens on one, God forbid, it doesn't take out the rest of your group. So we create these vehicles, is another phrase we use. Some of it is also to use the power in our tax system as well, or the flaws in our tax system, whichever way you want to look at it, to basically make sure that we're mitigating the tax across the group as well, and making sure that if you're doing things for an investment purpose, you want to be making sure you can reinvest money and not paying excessive tax so that you're only getting partial benefits in reinvesting, and doing that as a strategic play. And the other overlay to this as well is structuring is really important when it comes to complying with all of our red tape areas across the country, whether that's dealing with iCare or QBCC and the trust issue. Structuring is really important to get right in the context of the regulatory requirements and your sort of day-to-day commercials as well. Now, here's a number of example structures. I'm not going to unpack every single one of them, and you can also stack these on top of each other as well. All I'm highlighting here is there are many ways you can structure all of this, and the key thing is getting the right advice and sitting back and stopping before you go diving into anything, and having a good think about how should I structure this, and having a good discussion with your accountant on, well, how can we get the best tax outcome and mitigate the risk all at the same time. So structuring is a really clever way to get the best outcome, and wealth creation is structuring is actually one of the key gateways to wealth creation, particularly in Australia.
Yeah, I just reiterate what Josh has just said there too. It's important to get it right at the beginning. Once the project is underway and you're actually in the middle of doing it all, it's too late to change the structure. Well, it's not too late, but it could cause you a lot of tax issues and complications to do it that way. There are instances where you might find a property that you say, no, that's it, that's the one I need. You need to go to contract. There are some limited circumstances where you may be able to change the contract. But once you've gone to settlement and once the project's underway, you're pretty much stuck with what you've got without it costing you a lot of money to unwind it or to make it different. So it's really important to have those conversations with your accountant at the start when you're starting to think about the project or look at an option of what you want to do. So why sometimes do we want to do these things? Phil's just popped in.
Just randomly popping in just to say we probably need to get a hurry along now.
Yes, we are. Yeah. So yeah, we've only got a few slides left. I
nearly
think.
Nearly there.
Yeah. So look, why do we want to do these things? In our experience working with builders, often you guys get to this point where you've got a little bit of cash floating around and you start saying, you know what, I want to do some of these things for myself now. I want to build my wealth. I want to dabble in a few little projects here and there. Important things to consider from a tax perspective. Why? What are you doing the project for? Is this a long-term thing? Are you buying to do a bit of a renovation and hold the property, potentially rent it out for 10, 15 years? Or are you doing this as a quick flipper where you can buy the property, reno it, and just sell it? Each of those kind of activities, or depending on what you're looking to do, what your purpose is, could have different outcomes. And we're not going to go through any of those now, but just highlighting that they will have different tax outcomes. GST can kick in on different projects that you're running as well. A lot of people miss that and get caught by that at some stage. If the ATO starts to come and sniff around what's happening with this project, you might find yourself suddenly thrown into the GST arena without realizing that that's now an additional cost you've got to consider with the project profits. CGT as well. We've mentioned early in this presentation about main residence and what the implications are there. Some of these projects people run as, I'll buy it, I'll live in it while I reno it, then I'm going to sell it, I'll move into the next one and do the same thing. You might get away with main residence for the first couple. Once you get down the track and there's a pattern that this is happening, you might actually find yourself outside of CGT and back into the income arena with different tax implications. So it is really important, as we said before, to have those conversations with your accountant about what are you doing it for, how long have you been doing it, what sort of projects you're running, etc. Loads and loads of examples of this. Flipping, I mentioned before. Splitting is also very popular, where you'll find a block and say, look, that's enough to put 2 or 3 houses on. I think I'll do the DA split and then build. Some people will do the DA, sell the land. So splitting is a really popular one. 2 packs, 3 packs, even 4, and more than that even. We start to see other things coming into play there as well in terms of tax. So it's really important, again, to get that advice. Renovations are a big tax topic, because you can do a small renovation, you can do a major renovation. Each of those, again, could have different tax outcomes depending on what you're doing, and different GST outcomes as well. So again, getting the right advice. And when I'm talking about small reno, it might be you've got a property that's largely okay, you just want to rip up the carpets, maybe do a repaint and a couple little touch-ups here and there and resell. That might be totally okay. But another one you might look at and say, actually, I pretty much got to gut the place. I'm going to have to knock that wall down, pull that one out there, put another room over there. Suddenly it's a major reno that could have completely different tax outcomes for you. One really popular one we're also starting to see now, particularly with the housing crisis, is share housing, where people are looking to buy and renovate properties and then either treat them as dual occupancy, or they might have share tenants, share housing in there. So 5 rooms all being rented to completely unrelated individuals. So again, tax outcomes and tax implications of all of these different types of projects and development activities can be very different. So it's really important, if you are looking at them, to start getting into that, or getting into that space, to start having those conversations early with your accountant to make sure you're getting that right.
Yeah.
Josh, coming back to super.
Yeah, I'm going to touch on this. Key thing is I cover this a bit more in the ebook, so I would refer to the ebook around the self-managed super. I've put the obligatory disclaimer here because this is squarely, again, financial advice area. Don't be jumping into self-managed super until you've got actual financial advice. But I just wanted to high level, why do we do this? Because it often comes up as a discussion point. You might be talking to colleagues or friends that might have one or talking about it. So what is it at a high level? It's you now taking complete control of your retirement savings, right? So what we're seeing very common these days, particularly those in building construction, is eventually needing a commercial premises for storage and actual office space, and then wondering, well, how do we fund it? Self-managed super is a vehicle that is possible. It's just one of the example structures to use, so it is just a structure. There are some strict rules around super, so you must get the right advice up front before diving into it. You are in control. You are the trustee, so you have the obligation to run it. There is the capacity to borrow under super. You have to do it in a specific way. The ebook actually shows you a diagram of how you have to do it, the limited recourse borrowing, but you can borrow in super. It's very strict, as I said, around the rules though. And the key thing, why is super so incredibly attractive in this country? It is because the tax rate is quite low, at 15%, 10% for capital gains. And look, if you hold the asset all the way to retirement, you may be in a scenario where the tax rate is 0. So it is an attractive vehicle, but get the right advice. Here's a really quick example of what can it save you. Basically, your company rents the premises, the building. It has to be business real property or commercial premises. It rents it from your super fund. It pays commercial rent, proper arm's length rent, and the company gets the tax deduction for it, and it's only taxed at 15% as it goes into super. So we've got some tax savings as an overall benefit there, but really it's an investment decision you're making. And the other little benefit is you're now growing an asset for yourself. So it's a valuable investment that you're holding until retirement. Now, Phil, what if we're on fire, mate?
Realised that I actually was on mute there. There was our ambulance. If you are in some kind of trouble from a tax perspective and you've, over the last few years, been in a position where it's been hard to stay up to date with your obligations in that area, there is this thing called small business restructuring, which if your debts to unsecured creditors, so you can only use it for unsecured creditors under $1 million, there is this option to have a restructuring practitioner go to your creditors and make an offer to them to I guess discount or make a better offer on what is outstanding. It's a good option because it doesn't mean that you have to hand control over to a liquidator. So the other insolvency options just mean that you've got an administrator involved and you lose control of the company. And we've seen a fair bit of activity in this space now, and the ATO, it really does depend on the particular circumstances, but there are offers that are going through in the order of 20 to 30 cents in the dollar, which if you've got an outstanding ATO debt of $300, $400, $600, whatever, $600,000 I should say, in that vicinity, being able to use this as an option to make a significant amount of that debt to the ATO go away is a good option to consider. There are a number of settings around it though, so you just really need to be careful about whether this is right for you. And it is a good option for those businesses that actually have a decent underlying business and are going to be able to continue to trade on, but are carrying this debt, and no one really wants to be in that position longer term. Importantly, in Queensland, it's also not a insolvency event from a QBCC perspective. So whereas other options in that space are and would be damaging to your license, but in terms of QBCC, the SBRP option is okay from that perspective. I'm going to keep going. We've got this ebook we've talked about. We will be sending it out as part of a follow-up from the registration. You'll get a link to it. It covers a bunch of the content we've covered today. We've got a quick poll. Julian, are you still alive? Are you still there?
You're still with us.
Still there. I'm still there.
Wonderful. And I'm sure you've learned a fair bit yourself today. If you would like to set up a consultation with either Julian about Bill Exact or with the team at Exact Accounting, there's a poll coming your way here. Just tick the box and we'll get in touch and set up a time to have a chat. We often, people use that as just another set of eyes. This isn't about necessarily having to switch accountants or anything like that. It's often just, at end of financial year, am I really getting the right advice on this, that, and the other? Can you have a look at it for me? And we're more than happy to do that.
For some reason, Phil, the poll, the launch button is there, but it's not letting me click the button. It's great.
Okay. All right. Well, what we might do is we'll just in the email when we send the video around to everyone, because we'll send a recording of the video, we'll send a link to the ebook, and we'll send a link as well to a form there, so that if you do want a consultation with either of us, or it looks like it's working now, you can tick the box here as well. We're really just over time now. Happy to hang around for questions if anyone has any other questions. We've got just a little bit more time here if anyone wants to discuss anything in particular, or you can just tick the box there and reach out. Obviously, we really love this stuff and we enjoy it. We enjoy having an impact for our clients. I know Jules does as well. And so, if you ever want to have a chat about any of this stuff, just reach out and we can set up a time. Be good to catch up.
Yeah.
Don't think we've got any other questions here.
Thanks, Melody.
Nothing come in yet, so guessing
great.
Quite a lot.
Yeah. All right. What do you reckon, Jules? We call it?
Yeah, let's call it. I'll end
Thanks, everyone.
And yeah, guys, really appreciate you jumping on, giving your advice. I know it's a long day, and obviously it's end of financial year time for you. So I know you're flat chat at the moment. So really appreciate you jumping on.
Come.
Yeah, thanks everyone for coming along. And thank you again, Jules.
No worries. Yeah, and thanks
Thanks,
everyone
Jules.
as well. All right, we'll cut
All right.
there.
Let's do it.
Brilliant.
Thank you.
See you
Wonderful.
guys
Okay,
later.
see you, mate.
Bye.
Bye.